Hello and welcome to the lecture on leases, specifically Statement 87, which is the GASB's new guidance on accounting and financial reporting for leases. What I'd like to do in this lecture is briefly cover how leases have been accounted for up to this time, um, setting the stage for explaining why the standards are being replaced, and of course tell you what the provisions are of the new standards for leases. So looking at the way things have been up to this point, the standards for leases for the GASB are codified in Section L20 of the GASB's codification. Much of that is actually FASB established guidance as it existed on November 30th, 1989, which is the date of the finalization of the jurisdiction agreement between the GASB and the FASB 5 years after the GASB was created and after a study was done to evaluate GASB's effectiveness in that first 5 years. And so they kind of, set in stone everything that was applicable to state and local governments in the FASB literature, as of that date. That could be applicable to GASB, but any changes made by FASB after that would not be applicable to state and local governments. And those standards, even prior to November 30th, 1989, would only be applicable if they don't conflict with or contradict GASB's own standards. And so over the years, GASB established standards in a number of areas that replaced a lot of that guidance, but leases is an area that they did a little bit of work in with GASB Statement 13 on a particular kind of lease, but never went back and fully examined the existing literature. And then with GASB Statement 62, which was the culmination of GASB's project to take all of that literature, not just leases, but everything else that applied to state and local governments but resided in FASB literature or in AICPA literature, and to bring all of that into the GASB's own codification. That guidance from FASB Statement 13 primarily was brought into the GASB literature, and that plus NCGA Statement 5 plus GASB Statement 13 and some other minor pieces of pronouncements are all codified together in Section L20. As you know, the main feature of the old approach to leases was this distinction between capital and operating leases. If a lease meets any of these four criteria, it's considered a capital lease. If the lease transfers ownership of the property to the lessee by the end of the term, if the lease contains an option to purchase the leased property at a bargain price, if the lease term is equal to or greater than 75% of the estimated life of the leased property, or if the present value of rental or other minimum lease payments equals or exceeds 90% of the fair value of the leased property. Those are the things that would trigger considering that lease to be a capital lease. All other leases are considered operating leases. And as you know, quite a lot of engineering has been done of the terms of lease contracts by private companies and by governments as well, to just skirt underneath those criteria so as not to trigger the accounting and reporting that's required for capital leases, which is significantly more than is required for an operating lease. Speaking of which, if you're just talking about an operating lease, then all you're essentially reporting are the inflows and outflows related to that lease. So if you're the lessee, you're the entity that is acquiring the use of the capital asset, then you're reporting your payments as they come due and as they're paid. And if you're the lessor, whose property is being, the right to whose property is being conveyed to the lessee, then you're reporting the inflows of resources related to that. On the other hand, if it's a capital lease, then the lessee is reporting a capital asset and a long-term liability related to that lease, And that's obviously a lot more work, and it has different implications for the face of the financial statements because you are now adding a liability to the face that wasn't there before. So, the result is that uh, entities were structuring their leases in a way that will allow them to avoid identifying them as capital leases and therefore have to capitalize an asset and report a long-term liability. So, for example, a government signs a 10-year lease agreement for some equipment, and that requires annual payments of $100,000 a year. And that begins on July 1, 2016. And on each successive July 1, they need to make a payment of $100,000. And the equipment is delivered on the first day of the contract, July 1, 2016, just to make things simpler. And this lease meets the criteria of a capital lease. So we have to report a capital asset and we have to report a long-term liability. We use a discount rate, and let's just say in this case it's 10% just to make it easy. So the present value of the 9 future payments, not the initial payment, you don't need to present value that because it's already in the present. So just the 9 future ones, their present value at 10% is $575,902. So plus the initial payment of $100,000, and then you've got an amount that you're focusing on here of $675,902. So in the governmental funds, you're going to debit expenditures and you're going to credit other financing sources, capital lease agreements, in the amount of $675,902. In the government-wide statements in the proprietary funds, where you're using full accrual, you debit equipment and you credit capital lease obligation payable, again, in the amount of $675,902. In subsequent years, then, in the governmental funds, as those payments of $100,000 a year come due, you're going to record an expenditure, and you're going to credit cash if you're making the payment right away, or you're going to credit a payable until you do make the payment. In the government-wide statements, in the proprietary fund statements, under full accrual, you debit interest expense and your capital lease obligation payable in a total amount of $100,000. The breakdown between interest and capital is going to depend upon what the interest rate is and where along in the term of the lease it is. And then you're going to credit the cash, the $100,000, presuming you're making the payment right away. And then you've got a capital asset that you have to depreciate, and then you have to report in all other manners as you would any other capital asset that the government has. Another key feature, particularly of governmental leases, are these things called fiscal funding and cancellation clauses. So, a lot of governments are prohibited from entering into long-term obligations, and so they need to include these fiscal funding and cancellation clauses in their lease contracts in order to make it at least appear that they could back out at any time they want, and therefore they haven't committed themselves to a 10-year contract, for instance, even though they've signed a 10-year contract. In most cases, that option to back out is never exercised, and therefore what the standards emphasize is that you're going to follow the capital lease standards. You're going to capitalize the lease. You're going to report a long-term liability as long as the possibility of cancellation is remote, and in virtually all cases it is. Until there's really been some significant indication that the government will back out, the presumption really is that they're going to see that contract through for its full term. Now, I've already started to talk about some of the problems with the old lease standards, where they were basically being manipulated in order to avoid reporting a capital asset and particularly a long-term liability. So you have contracts that are economically exactly the same, and yet one of them results in the reporting of a capital asset and long-term liability because it's 75%, say, of the useful life of the leased asset, and there's another contract that's 74.9% of the estimated life of the contract of the leased asset, and that's treated as an operating lease, and you don't report a capital asset, and you don't report a long-term liability. And I think everybody has been well aware on both the private sector side and the public sector side that that's really not a very good accounting outcome. In the governmental sector, you also have issues of governments creating these other entities, most often in the form of component units, in order to enter into lease contracts, but not to report the liabilities on the face of the primary government's financial statements. So they end up being on the financial statements of the component unit. Other deals in which they're sale leaseback and leaseback arrangements where they are selling a major capital asset to a separate entity that they created, and that separate entity issues debt and takes the proceeds of the debt and gives it to the government to quote unquote purchase that asset, like the highway system or the prison system. Both of those are real examples. And then the government annually appropriates money in the budget to make a lease payment, and maybe you can hear me making my air quotes, to the component unit. So what it does is provide some cash up front to the government, which it probably uses to close a budget gap, and then it's gone. And now they're, for an asset the government already owned, it now has like a 20 or 30 year contract where it's got to pay off this new debt that the component unit issued to acquire these assets from the primary government. So there's a lot of stuff that's going on here that really is, if it's not illegal, but it's unsavory, and it ends up in accounting treatments that don't accurately or transparently represent what's really going on financially with the government. And so those were things that certainly for many, many years have been known about and really have needed long overdue attention to remedy. And that's where GASB Statement 87 comes in. This was issued in June of 2017. It has an effective date beginning after December 15th, 2019. So we're talking about fiscal years that begin January 1, 2020, that end December 31st, 2020, and later. So June 30th, 2021 for the June 30th fiscal years. So it's still a couple of years off, but there's going to be an awful lot of work involved in getting ready to implement this pronouncement, because it affects so many transactions. So many governments have leases, and some governments have so many leases, and they're all going to need to be reviewed in order to ensure that all of them are properly reported going forward. As you can see from this information here, that number is actually low, that 89,000. It's what's in the census of governments is over 90,000, and that doesn't count a lot of component units that are rolled up into the governments that are reported in the census of government. So it's really more like 93, 94,000 state and local governments. Many, many, many of them have capital leases, or at least long-term leases for capital assets. Whether they're reported as capital leases or not, is another story. There are an awful lot of governmental lessors as well, especially on the business type activity side, like airports and stadiums, casinos, ports and marinas, utilities, but lots of general purpose governments like states and counties and cities are lessors as well. So there's an awful lot of financial activity going on around these transactions. They're very common, and they involve a tremendous amount of money. As I said before, GASB has essentially incorporated the applicable FASB standards that haven't been reviewed for many, many years. Although, as you know, probably the FASB and the IASB had their own joint project, and they issued new lease standards about a year before GASB did. and GASB had been monitoring the progress of those projects as they were being followed by the FASB and the IASB, and so that provided an opportunity for GASB to kind of piggyback on what they were doing, and rather than starting from scratch the way FASB and IASB did, to look at what they did, to look at the decisions they made, and perhaps find a shortcut to coming up with an acceptable answer, a better set of standards than those that were in place. And in fact, I think when you look at Statement 87 and compare it to what FASB and IASB came up with, there are a lot of similarities, and certainly all three of them have gotten rid of that basic distinction between capital and operating leases. Now, all of them have certain exceptions to that, and I'll tell you what GASB's are, but there's still a lot of similarities, probably more similarities than differences in those standards, and a part of that has to do with the fact that GASB was able to examine what they were doing and apply that to a governmental environment and determine whether that was an acceptable answer for governments as well. And in most cases, they really were. So Statement 87 begins by defining what a lease is. And so that's important because governments need to know what transactions they're applying these standards to. And although you might say, well, why can't they just apply it to everything that's called a lease? The reason they can't is because there are many transactions that are leases in every way except for the fact that they're called something other than a lease. And there are many things that are called leases that really aren't leases at all. So this definition is very important, and it is a contract that conveys control of the right to use another entity's non-financial asset. So we're talking mostly about capital assets here, but it could be other things that are non-financial in nature. That's generally referred to as the underlying asset, and it is specified in the contract for a specific period in an exchange or an exchange-like transaction. So what's important about that is, we're talking about, really paying the value of leasing the right to use this asset, and it's not some kind of dollar transaction or greatly discounted transaction between a state government and a school district or something like that. So it's definitely got to be like an exchange, like it would happen out on the open market. If it's not, if it's a non-exchange transaction, there are existing standards for dealing with those, and it ought to be accounted for under those standards. So when we're talking about control, that means two things: that the right to obtain the present service capacity from the use of that underlying asset, that the lessee is acquiring that, and that they are then able to determine how they're going to use that underlying asset, that the lessor doesn't have any control over it after that. They're receiving this asset, now it's theirs to use as the lessee. It's important to know then, and you'll see this as we start to look at the debits and credits, is that what the lessee is acquiring is the right to use that capital asset, not the asset itself. That asset still belongs to the lessor. Certain things are excluded from the scope of Statement 87. So there are things that would meet that definition of a lease, but either they require some specific guidance in accounting and financial reporting that extends beyond the basic guidance for leases, or there may be guidance that already exists for them, or they need some specific guidance, some specified guidance that hasn't been developed yet. So intangible assets are one of those things. So that's something to keep in mind, that as I just said a little while ago, the lessee is acquiring the right to use the capital asset, and that right to use is an intangible asset. But leases for intangible assets, such as mineral rights or software, are excluded from Statement 87. Timber rights and other biological assets, inventory, transactions known as service concession arrangements are covered by Statement 60. Assets that are financed with outstanding conduit debt are excluded, and there's actually a separate project that the GASB is working on now to deal with conduit debt obligations, and they are talking about these types of transactions that involve conduit debt. The only exception here is that if the lessor is reporting both the asset and the conduit debt, that will be covered by Statement 87. So the basic thing to remember about Statement 87 is that it gets rid of the operating capital distinction and brings a basic assumption that all leases are financings. So, except for specific things that are excluded, all leases should be treated as capital leases effectively. The exceptions that I will talk about a little bit more are what are called short-term leases under Statement 87, and also leases that transfer ownership and that don't contain termination options. Those are sales of assets and not leases. For lessors specifically, leases of assets that are investments are considered to be leases, but there are exceptions to the basic requirements of Statement 87, and then certain regulated leases, in particular airline agreements. There are specific treatments for those types of leases that differ from the overall approach of Statement 87. So I just showed you exemptions from the scopes, exclusions from the scope, like leases of intangible assets. Those are completely excluded from Statement 87. These things are covered by Statement 87, but the basic overall model that applies to all leases under the notion that all of them are financings, there are exceptions here where a different type of accounting is done, but it's still covered by Statement 87. So one of the important things that a government needs to determine right up front is how long the lease is, because that's going to say a lot about the dollar amount of the lease and what needs to be reported and how often subsequent reporting needs to take place. And of course, then when the transaction ends and the capital asset needs to be returned to the lessor and the lessee no longer has the right to use it. So the place that it begins with is whatever the non-cancelable period is for the lease. So if it's a 10-year lease, you're beginning with that 10-year period if there are no options to cancel during that period. And then you're going to take into consideration whatever options the lessee and the lessor has. If there are options to extend and it's reasonably certain that option is going to be exercised, then that period covered by the extension should be included in the lease term. If there's an option to terminate the lease and that option is reasonably certain of not being exercised, then it's not going to shorten the lease term at whatever point that termination is allowed to include. For cancelable periods, those are those in which the lessee and the lessor both have the option to terminate, or where both parties have to agree in order to have an extension. Those are not included in the lease term, and that includes excluding these rolling month-to-month leases where essentially the two parties have entered into a long-term contract, but they structure it as a lease that renews itself at the end of every month. So it's like a series of 1-month leases. And that concept is important to remember when I talk to you about what's called short-term leases under Statement 87. Statement 87 carries forward the prior treatment of fiscal funding and cancellation clauses, which is that you should basically ignore them unless there's reasonable certainty that they're going to be exercised. And in most cases, there is not. So here's an example. You got a 5-year lease, and only the lessee has an option to cancel after the 4th year. So if you look on that first line, if it's uncertain that the lessee is going to cancel after 4 years, then the term is the full 5 years. If it's reasonably certain that the lessee is going to cancel after 4 years, then it's 4 years. Here's another example, a 5-year lease. The lessee has an option to extend to a 6th year. The lessor has an option to cancel after 4 years. So there are 4 different combinations here. The first combination, it's uncertain whether the lessee will extend or the lessor will terminate, so you stick with the basic 5 years. In the second combination here, it's uncertain that the lessee will extend, but it's reasonably certain the lessor will cancel after 4 years, so the term is 4 years. The third iteration here, it's reasonably certain the lessee will extend to 6 years, but uncertain whether the lessor will cancel after 4, so the lease term should be 6 years. And if it's reasonably certain both that the lessee will extend to 6 and the lessor will cancel at 4, well, then it has to be 4, because you'll never get to after the 5th year when the lessee could extend to a 6th year. It will be canceled after the 4th year. Here's a third example. The lessee and the lessor both have the option to terminate after the 4th year. So if it's uncertain whether either one of them will exercise, then it's going to be 4 years, and that's because, as I told you before, if if you have these situations, these cancelable periods, then they don't get included in the lease term. If it's reasonably certain the lessor will cancel after 4 years, then it's going to be 4 years. If it's reasonably certain that the lessee is going to cancel after 4 years, it's 4 years. And if it's reasonably certain that both of them will activate the option to cancel after 4 years, then the lease term is 4 years. The question arises as to whether there's ever a point at which this lease term that is established at the inception of the lease needs to be reassessed, shortened or lengthened. And that only is going to happen if one or more of the following occurs. So if the lessee or the lessor elects to exercise an option, even though originally, when you first determined what the lease term was, it was believed that the lessee or lessor would not exercise that option. Or the lessee or the lessor elects not to exercise an option that you thought they would exercise, or if there's an event that's specified in the contract that requires an extension or termination of the lease to take place. I've alluded a couple times to the short-term lease exception. This applies to leases that at the beginning of the lease have a maximum possible term under the contract, including any options to extend, of 12 months or less. And so if you hearken back to what I said before about those month-to-month rolling contracts, those wouldn't work here. The question came up during due process as to whether governments could just structure these as, well, could it just be an 11-month contract and they could just wink and a nod and it would get extended for another 11 months, but it wouldn't be a 22-month lease that would be reported like any other lease underneath Statement 87. They'd both be short-term leases, and this is structured pretty well to make it clear that you can't do that. That when you evaluate everything that is involved in the terms of the contract, that you will have a lease term that is 12 months or less, or it's going to be subject to all of the provisions of Statement 87. The reason the board did this is not because it doesn't believe these leases are like all other leases financings, but because the cost-benefit doesn't make as much sense when you're talking about something that's going to last 12 months. The value informationally of capitalizing the lease and reporting what really isn't ever a long-term liability, because at any given time the contract's not going to last more than a year. It doesn't it doesn't provide as much value, and so it doesn't justify the cost of capitalization and reporting of a long-term liability. So for the lessee and for the lessor, essentially they're going to be reporting these short-term leases similar to the way that operating leases were reported for. The focus is on reporting the inflows and outflows of resources related to the, the lease, and no capitalization, no reporting of long-term liabilities, or for the lessor, long-term receivables. And there aren't any disclosures in the notes that go along with short-term leases. So let's look at what Statement 87 then requires for all other leases. For the lessee, initially, when the contract is for the lease contract is first put into place, the lessee is going to report a capital asset. It's going to be an intangible asset that represents the right to use the asset, the underlying asset that has been leased. It should be valued equal to the lease liability plus any prepayments that were made and any initial direct costs that are ancillary to placing the asset in use. The liability, the long-term liability that they're reporting that balances off here is the present value of the future lease payments. And there's an awful lot of detail in Statement 87 about how to deal with various types of payments, like fixed payments and variable payments and so on. But the idea here is very similar to the way the capital leases were reported in the past, basing the amount of the liability on the present value of future lease payments. On the lessor side, the lessor is going to have a long-term lease receivable that is generally measured the same way that a lessee would measure their long-term liability. The lessor is going to continue to report the leased asset, and that includes depreciating that capital asset, unless, and there's just one exception to that, if the lease contract specifies that the lessee has to return the asset in the same or better condition than when they first received it. In that case, the lessor would not depreciate the capital asset during the term of the lease. So the lessor is reporting a lease receivable and then is also reporting a deferred inflow of resources that is equal to the lease receivable plus any cash payment that was received up front that relates to a future period. And so that's where you get your balancing here on the lessor side. In subsequent periods, the lessee is going to amortize that intangible asset over the shorter of the useful life of the underlying asset or the term of the lease. It's going to reduce its lease payments. It reduces its liability by its lease payments, by essentially the principal portion of the lease payments, excluding the interest expense. And it's going to report interest expense in its financial statements as well. The lessor, as I mentioned, is going to be depreciating its asset, and it will reduce its receivable by, again, what's essentially the principal portion of the lease payments that it receives or that it's due. And it's going to reduce that deferred inflow over the lease term in a systematic and rational manner and recognize revenue related to the reduction of that deferred inflow. So the deferred inflow is taking those future payments, and it's that's not revenue right away, right? So it's their inflows of resources that are related to a future period. So it's deferring the recognition of those inflows as revenue until the future periods arrive. So let's look a little bit more specifically at those accounting requirements that we just saw in general by starting with the lessees. So as I said, the lessees are going to recognize a liability for the future lease payments, as well as their intangible capital asset for the right to use whatever that underlying leased asset is. In the governmental funds, obviously they're not reporting any capital assets. They're going to report payables on those leases when they're due, but there is no liability there. There is no asset. I mentioned before that there's a considerable amount of detail in Statement 87 about how that lease liability is measured initially. I'm not going to get into that in any detail. That's beyond the scope of what we're covering in this course. But suffice it to say, there's a considerable amount of detail in the guidance that is provided to governments as to how to go about valuing this lease liability. A couple of things that are worth noting is that there's anything that's performance related, that's not a part of the liability because it's dependent upon things that are going to happen in the future. So if anything, they're contingencies, and that the discounting is done using the rate the lessor charges the lessee. And then there's guidance to provide if there isn't an explicit rate or an implied rate within the contract that is being charged by the lessor, guidance as to how the lessee should determine what discount rate they use, which is basically going to be whatever the incremental borrowing rate of the lessee is. So here are some debits and credits that are related to this. You've got a lease, you're calculating the liability. There were some actual payments that were made up front. There's amortization of the discount that was provided on the lease, which is treated as interest expense. So, in this case, and these are stated in thousands. So you're talking about 4 million, 18 million. You have an interest expense of 4 million, a lease liability. You're debiting the lease liability when the payment's made. So you have interest expense, you have a reduction of the long-term liability, and of course, you're crediting cash, so you have less cash. You made a $22,000 cash payment. Part of it's interest, part of it's essentially the principal, of the payment that reduces the size of the lease liability. This is much like you'd see for any debt transaction, because that's what this is. It's a financing. It's a borrowing. There's a considerable amount of guidance in Statement 87 regarding, what happens subsequently and in subsequent periods if certain things happen. In particular, what needs to be done if remeasurement of the liability is necessary. Again, that's detail that's far beyond what we need to cover in this course, but you have the information in these slides, and if you're interested, I do suggest that you take a look at those sections within Statement 87. On the asset side, that right to use capital asset that the lessee is reporting initially is going to begin its value with whatever the amount of the lease liability is. If the the lessee has made any prepayments that before the measurement of the liability, then that's added, excuse me, to that lease liability amount. And then if there are any costs that are incurred that are necessary in order to place the leased asset into use, those should be included as well. And then in subsequent periods, you're not depreciating that because it's an intangible asset. It's a right to use. So you're amortizing it and reporting amortization expense using a systematic and rational manner over either the shorter of the useful life of the capital asset or the term of the lease. And so generally, the way you're going to set this up is, if you're a government, is for the most part, you're beginning with relatively or very equal values between the lease asset and the lease liability, and you're going to set this up in a way that you're essentially reducing them in tandem over the term of the lease. There are a variety of disclosures that are required, many of them similar to what was already required for capital leases. Just a basic description of the government's leasing arrangements that identify some of the key terms and conditions, the total amount of assets that are recorded under leases, the accumulated amortization, lease assets disaggregated by major class of underlying assets, and again, in all these cases, identified separately from other types of capital assets. And then if there are variable lease payments that are recognized during the period of the financial statements that weren't previously included in the lease liability, those should be identified in the note disclosures as well. One of the other key things, you look at number 6 here, this is carrying forward a prior requirement as well, which is showing future lease payments for each of the next 5 fiscal years, and then in 5-year increments thereafter, showing the principal and interest portions separately. So that's done just like it's done for outstanding debt. If there are any commitments in the leases, for which the lease term has not yet begun, so they've entered into this lease, but the lease didn't begin during that fiscal year or prior to the end of the fiscal year that's being covered by the financial statements. The government is identifying those, and then if there is any impairment loss, on leased assets, the components of that net impairment loss are disclosed. On the lessor side, we're basically looking at the flip side of this transaction. So you've got a lease receivable and a deferred inflow of resources. The lessor doesn't derecognize the capital asset; it continues to report it, and it, except in that instance in which they're required to receive the asset back in the same or better condition. If it's a depreciable asset, they're going to continue to depreciate it. As I said before, measuring the lease receivable is very similar to how the lessee measures the lease liability, and it's a lot of detail that I'm not going to get into in this course. Perhaps if we had a few more weeks to go over all of this, it would be worth spending some time on that. But we really don't have the time to deal with it now in order to proceed to next week and to the assignment that you have related to leases. I mentioned before the deferred inflow of resources, which is initially the receivable amount plus any cash that was received upfront that relates to future periods, and then in subsequent periods during the term of the lease, in a systematic and rational manner, the lessor is going to recognize revenue by amortizing that deferred inflow of resources. It's waiting until the periods that those inflows of resources are truly related to the future periods of the lease before recognizing them as revenue. Similar to the way that the distinction is made between interest and principal on the lessee side, you have that same notion on the lessor side. So, some of the lease payments are interest revenue from the lessor's perspective, and some of them are reducing the amount of the lease receivable that the lessor has reported in its financial statements. And there's plenty of guidance in there as well about dealing with remeasurement and changes in the discount rate and so on. Again, that's a level of detail that's well beyond what we're going to cover in this course. One of the other key exceptions on the lessor side to this basic approach to the recognition of the long-term receivable and so on has to do with certain regulated leases, the best example of which are probably airline agreements. That when airports enter into these agreements with airlines, they're done under regulations from the FAA that put some pretty significant limitations on the airport as lessor. Most specifically, one of the things that in these agreements is that as long as the airline, or any airline really, complies with the requirements of the FAA and the specifics of the lease, any airline can participate as a lessee in these contracts, and the airport really can't stop them from doing so. And so it raised some questions as to the applicability of this basic model that Statement 87 lays out, and ultimately the board was convinced that those assets and those types of contracts, in fact, were significantly different from a basic lease contract, and therefore there's a different set of requirements in terms of the reporting in 87 for these regulated leases that have, and Statement 87 identifies the specific characteristics. You can't just say it's an airline lease or a regulated lease and get out of applying Statement 87's basic requirements. Statement 87 identifies the key characteristics of these contracts, and so if the lease contract has those characteristics, there's a different approach to reporting from that basic approach for the lessor of reporting the long-term lease receivable and the deferred inflow. There are also some very specific disclosure requirements that are related to these types of leases if they are taking advantage of this exception to the lessor accounting. Lessors are required, like lessees, to provide a general description of their leasing arrangements. They also should disclose the total amount of inflows that they recognized in the reporting period related to their leases if they're not separately shown on the face of the financial statements. If they are, an additional disclosure is not necessary. Like the lessee, this is sort of the flip side of the lessee disclosure. If there are lease inflows that are related to variable lease payments that weren't previously included in the lease receivable, those should be disclosed. If the lease payments are securing the lessor's debt, then there's some disclosure that needs to be made related to that debt and explaining how they're related to one another. Now, in cases where, what the government basically is a leasing entity, then there are certain disclosures that are required of them specifically because this is what they do. They're not just a government that has leases, but they're basically a leasing entity. Then this is kind of the flip side of the minimum lease payments disclosure. A minimum lease payments that the government, the lessor, is going to receive over each of the next 5 years and in 5-year increments thereafter, showing the principal and interest portions separately. Now, the slides that I've posted to the website have a lot more detail about other things like sale leaseback transactions, leaseback transactions, leases with multiple components, which actually is kind of a big deal, and I think will turn out to be a significant area where more guidance is needed for contracts that involve both a capital asset and service provision. So a lessor is providing not only equipment, but also is being paid to service that equipment and repair it if necessary, or to provide certain supplies related to the equipment. Maybe a lessor is leasing to a government a whole bunch of copiers, and it's also providing toner and paper and other supplies. There are specific guidelines in 87 about how to separate those parts of the contract into a lease and a service contract, so that only the lease part is accounted for under 87, and the service contract is accounted for like any other service contract would be accounted for. So there's a lot more detail in there in 87 about specific aspects of leases. And if you look at the slides that are available on the course website, you'll see that I've provided you some slides that give you an overview of those provisions, but it's really beyond the scope of what we need to cover in this course. And so I'm going to end the lecture here. And if you're interested, I encourage you to take a look at the rest of the slides and to, look at those other parts of 87 that aren't a part of the assigned reading for this week.